Hi, do you think that you make too much money to put money into a Roth IRA? Maybe not. And almost always, you don't. So, in this episode of Friends Talk Financial Planning, we're going to discover the secrets to how to do a backdoor Roth, which lets you put money into a Roth IRA while you're a high earner. Hi, I'm Bridget Sullivan Ramel, and I've got a family financial planning practice in Chicago, Illinois.
And I'm John Shearer. I've got a fee-only financial planning practice in Middleton, Wisconsin. And before we get into Roth IRA secrets, I just want to remind everybody to hit that subscribe button that help other people find this on YouTube. Go ahead and punch that like button as well. And then let's get into, I'm really excited. I like the idea. And we talk to people all the time, Bridget, I make too much money to do a Roth. I'd love to do a Roth, but I just can't do it because our income's so high, right? It's a good problem to have, right? You got high income. And I think what's the limits? If you're single, it's like around 140,000. If you're married, it's like around
if you're single.
138, married it's something
is
220,
218.
218, right? Yeah. So you go, hey, listen, I got income over that. I mean, the letter of the law says, well, you make too much money to contribute to a Roth IRA, right? But, right. And you mentioned it in the intro, there's a way to get into this thing, right?
Exactly. And so this has been going on for years. And now the IRS has pretty much said this is fine.
Yeah.
And so this is not a risky strategy. I would take it out of this is a risky strategy. This is just a strategy that isn't well known. And we'll talk.
And back in the old days, it was, hey, they didn't say we can't do this, so let's do it. Right now, they've said, yep, no, this is kosher to do, right?
Okay. So how do we do this? First, well, who is this for, really? So you're maxing out your 401k. Usually, we recommend maxing out your 401k before you do a backdoor Roth. The other thing is that, so another thing is I see people with a decent amount of an emergency fund, but then they've got some more money in a taxable account on top of that because they're good savers. Okay. Yeah. And so they might not be maxing out the 401k, but they have a bunch of money, or maybe they inherited some money. So we just move it to the Roth and then it's not taxable. That's nice. Yep. Okay. So those are the big situations where I see where I really recommend these, which is a lot of situations.
Yeah, right.
So the first step in this is the hardest. Okay. And that is make sure you don't have any IRA accounts around. All right. So if you have IRA accounts, then it deletes the benefit of doing backdoor Roths. Okay. And you have to have the IRA has to be cleared by December 31st. So they look at what was your IRA balance on December 31st. So a lot of people have put money into IRAs as rollovers.
Yep.
Okay. So you had an old 401k and you made a rollover and you have this IRA sitting there. So what you can do is transfer back to your 401k, wherever you've got a 401k. And I've seen about 99% of the time they take transfers. The ones that I haven't seen take transfers, and so from an IRA back into it, or that it might be a hiccup, is like a government where, the government agencies maybe a question mark, but you work with the state government. So do you have any problems with backdoor Roths there?
Yeah, we haven't seen anything, right? Yeah, because technically those aren't 401k, right? 457s or 403bs, and most of the time that those are good. I'll say one of the other things you made me think of is for people who maybe have a small business, maybe they sell things on Etsy, or they're doing something on the side, some consulting work. Those small businesses can set up a solo 401k plan, and it really is very similar to an IRA, but technically a business plan. That can be another great way to handle that.
So you can just put the money into that 401k, and I think you'll probably need an EIN to start one, and you'll want to save your paperwork.
Yeah. A little bit more hassle, right? Depends on your hassle factor, but there can be a way to do it.
Yeah, and we encourage people to do it. So there's some hassle factors that we don't encourage people to take, but then this is a hassle factor. I think of it as a traditional great tax strategy. And we were just at a conference, both John and I, and we had presenter Steve Jarvis, and he was talking about how tax savings is generally small moves made consistently over time. I thought that was a really great way. And that's the heart of backdoor Roths. Okay, so back to more details about backdoor Roths. So first, make sure you're clear on IRAs. Second, contribute money. Okay, and for 2024, you can contribute 6,500 if you're under 50, 7,500 if you're over 50, and that's for 2023. In 2024, it's 7,000 to 8,000. Okay.
Yep.
So
now, when you say contribute money, Bridget, where are we contributing that money to? Well, not to a Roth IRA, right?
no, you don't contribute it to a Roth IRA. You put it in a non-deductible IRA account. So you have to have a IRA account. The titling, calling it a non-deductible, is more for your convenience. It's not an official category of your custodian or of the IRS. So if you open an account that says IRA account non-deductible, then you'll know this is the one I'm using for the strategy. But you can use any old IRA account. But again, it needs to be clear when you start.
Yep.
Okay. So step one, contribute money. Step two, convert the money to the Roth. Okay. So you need to have a Roth account at the same custodian, and then you can do this transfer, but make sure you note on the transfer that it is a Roth conversion. So that means that you'll need or you might have to call the custodian. You just want to make sure that it's coded correctly. All right. Because then what you're going to get at the end of the year is called a 1099-R. Okay. And that's going to be from your custodian, and it's going to say you converted money from your IRA to your Roth. And it'll say $7,000 on it, or 7,500, however much you put in. And then it's done. Okay. There's a tax situation also. Okay. So you have to report this on your taxes. So you'll have your 1099-R that you're going to report on your taxes. And then you need to fill out an 8606 as well. Okay. And the 8606 shows the basis that it was a non-deductible contribution, that you didn't get a deduction for it, and that these zero out, and that you don't owe any tax for this conversion. Okay. So you can do the Roth contribution up until April 15th of the year following the tax year.
Yep.
Okay. So right now it's 2023. You have until April 15th. Okay. My big caution is to do the contribution and the conversion in the same year. These days, again, because the IRS has given it their okay, they say, you can do it within a day or two is fine. Okay. So just do it. If you can do it right away, this helps limit the number of notices you might get from the IRS, because it is fine for you to put the money in, and then technically it's fine for you to put the money in anytime before that date and convert it at any time in the future you want and just pay the tax. However, from a pragmatic level, if you don't like getting notices from the IRS, it's nice. They like it if you get the 1099-R, if they have the 1099-R and the 8606 in the same year. Okay. So this is all pretty complicated. It sounds complicated, but it's not that hard. Okay. Now, when I started this strategy, it was even before I had my financial planning practice. And so the resource I used, it's called White Coat Investor. It's a blog. They were a doctor who started blogging on finances way back, in the dawn of the internet.
Yeah.
And they're very detailed about how to fill out the 8606. If you've got questions on that. And again, your tax planner should be able to do it. Or if you're doing your own taxes, make sure you show that you made a non-deductible IRA contribution. Make sure the 1099-R is on there, and then make sure the 8606 is filled out. Okay. And then you should be notice free. But again, go ahead.
I was going to try to call you out for on the jargon police, but unfortunately the IRS gives us these forms that literally these are the names of the forms, right? There's no other place to do this. And that's where it's not simple, but it's also not that complicated. It just sounds that way when you have to know these inner workings, isn't it?
Yeah. And if you have a list of this is how you do it, that's fine. And again, this is just like a single. It's like if you're playing baseball, it's like getting a single.
Yeah.
You can just build this up over time. And then at the end, you're like, oh, this is kind of nice. I got some actual money in here.
So to circle back on the sort of 30,000 foot view, right? What we need to do is we need to put money into a regular IRA that you don't get to take a tax deduction for.
Mhm.
Then take that regular IRA, because you can make anybody can make a contribution to an IRA. Then anybody can convert an IRA to a Roth IRA. So it's a regular IRA contribution that's no tax deduction, a conversion then to Roth IRA. Now you've got money, instead of just putting it into the Roth as a contribution, we've got this sort of circular route through the regular IRA. Right. That's at the end of the day. And then make sure that you file the right tax forms, it gets reported in the right spots. Otherwise, the IRS is going to send you a love letter saying, hey, what's going on here? And you have to explain yourself in a little more detail than's necessary. Is that a good summary of things?
I think that's a good summary.
That's great.
Now, I do want to get into a polemic about why nobody knows about this. Okay. And it might be considered a polemic, and maybe polemics are only in writing. I don't know, but it frustrates me that more people don't know about this. And I think the financial industry does a disservice. Why is that? I think it's because there's a lot of paperwork involved, and advisors don't really care that much about taxes. A lot of advisors, John and I do, but they don't care that much about taxes and tax strategy. They just want to work on your investments. And doing a lot of shuffling around with paper, this kind of paperwork, even though in the long term it's great, in the short term it doesn't really do anything for them. And if they're moving money from one account that they have to another account that they have, they don't make any money. That's a neutral to them. For us, it's like for me, it's what I live for. It's great. So
I'll tell you the other thing that for me is frustrating is on the other side of it, that the rules, why are the rules written so that if you make too much money, you can't just make a contribution, but you can, it's legal, and you have to do these shenanigans basically to do the thing. Why not just make it? But that's a different discussion for a different day.
Yeah. And the other thing is that it is on the radar of Congress. So during the most recent Secure Act negotiations, this was on the table. Backdoor Roth, getting rid of Backdoor Roth was on the table, but they didn't go for it. They didn't do it. So it's not necessarily going to last forever, but it is a great strategy. I wish they would just get rid of the income limits for it.
Yeah, that's right. That's right. Well, I think that's a great place to wrap things up here. Again, I'm John Shear, and I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan Ramel. I've got a fee-only financial planning practice in Chicago, Illinois. We're both taking clients, but we're also members of ACP, or the Alliance of Comprehensive Planners, which is a group of planners that think a lot like we do, tax-focused, comprehensive financial planning all throughout the country. And you can check that out at acplanners.org.
And don't forget to hit that subscribe button.